the IRS is beefing up their workforce. That way they can increase their audits and increase their tax enforcement. That's generally not good news for taxpayers or the people that aren't paying their taxes, but a little piece of good news is the IRS is adjusting their tax brackets in 2023 to adjust for inflation. Here are the numbers for 2023 if you are a single taxpayer. If you're married, you're just going to double the limits except for one exception. So if you make under $11,000, well, you're only going to be paying taxes on 10% of that. Between $11,000 and $44,475, you're going to be paying 12%. Between $44,475 and $95,375, you're paying 22%. From $95,375 to $182,100, you're paying 24%. From $182,100 to $281,250, you're paying 32%. From $281,250 to $587,125, you're paying 35%. And then anything over $587,125, you are paying 37%. Now, the exception, if you are a married, filing jointly person, is this high 37% tax bracket. For all of these, if you're married, filing jointly, you just double the numbers here. That's how much you're going to be paying in taxes. But if you're making over this amount, well, if you're married filing jointly, the 37% is not the $1 million and some change. It's $693,750 for married filing jointly for the 37% tax bracket. Now, there's a little bit of education on how tax brackets work. If you make $45,000, that doesn't mean that you no longer fall in this bracket. The way it works in a marginal tax bracket system is you're going to pay 10% in taxes on your first $11,000 worth of income. Then you're going to pay 12% in taxes between $11,000 and $44,475. And then you're going to pay 24% in taxes for the other $525 between $44,475 and the $45,000. So if you make 45 grand, that doesn't mean that you're going to pay all of your taxes at a higher tax bracket. It just means that the marginal amount that no longer is in this bracket is going to be paid by this amount. Now, if we compare these 2023 tax brackets with the 2022 tax brackets, you're going to see some interesting information. And the way that I did my analysis is that I compared the top end of a tax bracket in 2023 with the top end of the tax bracket in 2022. So for example, what that means is the 12% tax bracket in 2023 is $11,000 to the top end of $44,475. So I'd compared this top end of the tax bracket in 2023 with the top end of the same tax bracket in 2022. So if we dive into the numbers, in 2022, the top end of the 10% tax bracket was $10,275. Now in 2023, it's going to be 11 grand. That's an increase of the top end by 7%. The 12% tax bracket in 2023, the top end is $44,475. In 2022 is $41,775. That's an increase of 6.5%. In 2023, the 12% tax bracket top end was $95,375. In 2022, it was $89,075, increase of 7%. The 24% top end in 2023 is $182,100. It was $170,050, increase of 7%. Now things get really interesting. The 32% top end in 2023 is $281,250. It was $215,950. That's an increase of 30% on the top end of the 32% tax bracket. For the 35% top end in 2023, it is $587,125. It was $539,900. That's an increase of 8.7%. So generally, for incomes under this $182,000, it was about a 7% or so average increase. But then for the 32% top end and above, is a lot more than that. They also indicated that they're going to increase the size of the standard deduction in 2023 to $27,700 for a married filing jointly couple, which is up about $1,800 from 2022. And a couple interesting changes that are coming in 2023 that weren't mentioned are deductions that are expiring. For example, you have Section 179, which had a special exemption through 2022, which allowed businesses to depreciate 100% of certain machinery in the year that they purchased the equipment. Well, the 100% exemption is set to expire at the end of 2022 because, well, that's when it's set to expire. And unless Congress changes that, that's going to be expiring on December 31st, 2022. I'm going to show you why this is a big deal in a second. So let's assume that you're a business and you made $1 million of profit, you have $1 million in your bank account, and then you decide, that's a lot of taxes that I'm going to have to pay on this $1 million worth of profit. I wonder if something that I can do. So you talk to your accountant, the accountant says, well, you can buy some heavy machinery. And now what you do is you go out and you put down $200,000 to finance this $1 million piece of machinery. So you bought this machinery for $1 million, but you only put down $200,000. You're going to use this machinery in your business. But now, because of this Section 179, you were able to deduct 100% of this value today. So now you could tell the IRS, hey, I have 800 grand in my bank account, but I have $0 of tax liability because I financed this $1 million piece of equipment. You still have the 800 grand in your pocket, but you were able to use this $200,000 worth of financing to now limit all $1 million worth of taxable income. Now, of course, before you go do any of this, talk to a tax advisor, talk to a professional. Make sure you have a good tax advisor because this does take some clever accounting. So you want to make sure you have a good tax advisor. But the reason why this is so important is because a lot of people use Section 179, not just for machinery, but also for heavy cars. Let's assume now that you don't have a big $1 million a year profit business, but your business makes a nice $50,000 a year. And now you talk to your accountant about different things that you can do. Well, your accountant might say that the Section 179 says that you can now use some of this money to buy a heavy vehicle, and now this can be used to lower your tax liability, assuming this vehicle is used in your business. So let's assume now that you go out and you want to buy a $100,000 car. You want to go out and you want to buy a G-Wagon. So you want to buy this $100,000 car, but you don't have 100 grand in your account. So what are you going to do? Maybe you put down, let's say, $15,000 to go out and buy this G-Wagon, and you're going to finance the rest. Well, now, if you can deduct all 100%, if you can show that you use this vehicle completely for your business, then you can deduct 100% of this $100,000 against your $50,000. So now what happens? You have 35 grand in your bank account, and then you get to tell the IRS, hey, I got this heavy vehicle, I got this G-Wagon, and it's 100 grand. So now you lower your tax liability by, let's just say $85,000. Let's assume that you don't use the vehicle 100% in your business. You have some personal use for it as well, so you pull back 15%. But you deduct 85% of that against your income. Well, now, guess what? You have $0 worth of tax liability this year, and then next year you also get to carry forward a $50,000 loss because you bought this G-Wagon today. So this Section 179 deduction, which allows people to deduct up to 100% of the vehicle this year, is expiring in the end of 2022. This is one of the reasons why it pays to have a good accountant, because if you have a good accountant, not only can you strategically use your money, but you can also pay less money in taxes this year. You can also pay less money in taxes the year after and have nicer things. So this is where it pays to have a good accountant. So if you don't have a good accountant, I highly recommend you looking around for one. Now, before I jump into some of the other things that are changing, if you are a business owner and you like to stay up to date on what is happening in terms of entrepreneurship, business, innovation, and trends for business owners like this, well, you can join Business Briefs. It's the completely free newsletter that I created for entrepreneurs, for founders, for business owners to keep you up to date on what's happening with business trends and innovation and funding and just things that are changing for entrepreneurs. So if you want to join Business Briefs, it's completely free. I'll put the link to how you can join Business Briefs down in the description below. Another similar popular deduction that's scheduled to be phased out at the end of 2022 unless Congress changes is the meals deduction, because in 2021 and 2022, Congress passed an act which allowed business owners to get a 100% write-off, a 100% deduction on meals because, well, restaurants were hurting because of the pandemic. So to encourage businesses to go out and eat at restaurants, they created a 100% meals deduction, and it is scheduled to expire at the end of 2022. That doesn't mean that you can't deduct anything for meals. It just means that you might not be able to deduct 100% of the entire meal when you eat at a restaurant with your team and employees and customers. Now, the reason why it pays to understand the tax code is because income is taxed differently. You pay taxes not just on money that you earn, but you pay taxes on taxable income that you have in your bank account at the end of the year. And according to the IRS, well, not all income is created the same. According to the IRS, there are 3 different types of income. You have earned income, portfolio income, and passive income. Earned income is the money that you make from your job. You go and do something and you get paid, that's earned income. Portfolio income is what most people consider your investment income. You sell a stock for profit, you get dividends, that is your portfolio income. Passive income is things like royalties. This is things like your rental income if you own real estate, that is passive income. Well, do you know which income has the highest tax rates and the least deductions? Earned income. Your ordinary income, the money you make from your job, you pay the highest taxes. These are the marginal rates that I was showing you a little bit before. You pay the highest taxes and you have the least deductions. If you can now create a business or you invest your money, now you have the opportunity to dip into these types of income where now not only can you get the benefit of lower tax rates, but you can also get the benefit of higher deductions. We just talked about meals, we talked about cars. I mean, we're just scratching the surface with the types of deductions out there. But this is where, if you are an entrepreneur or if you are an investor, because not everybody's meant to be an entrepreneur. So I don't recommend you go out and start a business just because of the tax benefits. But if you are an entrepreneur, you need to have a good accountant. You need to have a good attorney. If you need an attorney, I have an attorney referral service where you can contact someone from my team and then they will refer you to a good attorney in my network. I got the link for that attorney referral service down in the description below. But you have to have a good accountant. You have to have a good attorney to protect you because there are so many laws and so many regulations out there that can change the way that your business is done and they can change how much money you keep at the end of the year just because you didn't have a good advisor on your side. But if you are not cut out to be an entrepreneur, that's okay. Not everybody is, but you can still take advantage of these lower tax rates by investing your money. Guess what? When you invest your money in stocks, you invest your money in real estate, you get tax breaks. The tax rates you get are going to depend on how you invest your money and how you get paid. But this is where you have to understand, not only do you get the benefit of earning more money and building wealth when you invest your money, but you also get tax breaks. The government is incentivizing you to invest your money as if the returns from investments weren't incentives enough. So, if you are not investing your money, this is a reason for you to start investing your money. And if you are investing your money, especially if you have a diverse portfolio, meaning you have things like stocks and real estate, then this is where it pays to get an advisor on your side as well, because now your advisor can help guide you on how you can use the right deductions from your real estate, from your stocks. That way you can pay less money in taxes legally, because, well, at the end of the day, it's not how much money you make that matters, it's how much money you keep. And if you want to be able to keep more money, you got to understand the game, you got to understand the rules. In this stage, I was making, I don't know, maybe $100 some $1,000 a year. I was still really young, trying to understand the system. I was stuck here for a very long time, like years. I was stuck in this mindset. This was one of the hardest ones for me to break out of, because I got stuck in this idea of I don't want to spend any money on anything unless it